All right, class. What I wanted to do is I wanted to start out with our sort of by talking about our lecture notes, units 8, but specifically DCF analysis. So if you look at capital budget and discounted cash flow analysis, this is going to be the PowerPoint that I want to use. If you could also open up the assumptions for introductory DCF problem, that would be it's empty right now. That would be a good thing to do. And then I'm gonna focus on that now. So if we go back here, what are we doing here? We've seen this slide when we did Chapter 8 discussion. So we want to look at NPV and revisit the steps of capital budgeting, right? So first of all, we want to start out by estimating the cash flows of the project. Now in Chapter 8, we didn't spend much time doing this. We were just giving cash flows. So we wanted to get the techniques down, right? So in this set of notes, we're actually going to spend a lot of time looking at that first step. So that's going to be a big deal for us. Second step, determine the opportunity cost of capital. Okay, so we're going to go out, we're going to look at, how we would come up with that. So far, we've been given the opportunity cost of capital. Later in the class, we'll actually spend more time talking about where it comes from and ways to determine it. Third step is going to be apply those techniques that we talked about in Chapter 8. So I'm listing NPV here, but it could easily be IRR or profitability index, maybe all three on a project. And then the last one is, okay, now determine the selected alternative and implement it in your company. Okay, so I'd like to start this set of notes out with a capital budgeting example. So I've got this information here. What I'm going to do now is I'm actually going to go and I've reprinted those assumptions right here with the thought that I want to talk a little bit about, I want to sort of show you how these assumptions will lead into a cash flow analysis, okay? And then my plan is we'll come back and I'll jump back in the notes and I can kind of come back and refer back and forth to what we did here and where we're seeing it in the notes, okay? So I've laid a lot of things out here. Don't worry too much at this point about, hey, what is all this stuff? You can use this empty template and then we'll fill things in. Okay, so one of the things that we're doing when we do an analysis like this is we're going to create almost like a little set of financial statements just for the project. It's almost like we have a little mini company that we're creating and we want to capture the financial information for. Not all the financial information, but the relevant financial information, okay? So I'm going to start out, I've got an investment of, let's say $90,000, okay? So what do I do with that? Well, first thing I want to do is I want to say, why am I doing this? Well, one thing you should understand about this kind of an analysis is it's an incremental analysis. What I mean by that is we're going to spend this money and the question we want to answer is what's going to change as a result of spending this money, okay? Well, the first thing we see here is we're going to make an incremental amount of $50,000 in sales, okay? So if I'm going to capture it in revenue, what I'll want to do is I'll take and I'll say, well, that would be sort of like my P times Q, if you will, right? So here's what I'll do. I'll say equals, I'll say the price is 50,000 and I'll multiply that times my quantity. Price is $4 times the quantity of 50,000. So I get 200,000, okay? Then I say, okay, well, what's my variable cost? Now this is variable cost in total. So what I'll do is I'll say, okay, well, I want variable cost per unit times my quantity, okay? So here I'll say, well, I've got, again, my variable cost is $250 per unit times my incremental sales, so that'll be like 125,000. So then I'll say, okay, so 200,000 minus 125 gives me gross profit of 75,000. All right. Then what I want to say is, okay, so I've got a fixed cost of 25,000 per year. All right, so let me just stop and just talk a little bit about this. Okay, so here's what I think I'll sell in revenue. Okay, then there's going to be certain costs that are variable. In other words, they go up and down tied to the Q, or the quantity sold, right? So the biggest variable cost that we typically think of is things like cost of goods sold, right? Now, there could be other variable costs. Sales commissions are a good example of that. But for the most part, the big 800-pound gorilla there is going to be cost of goods sold. Okay, then I get my gross profit. In essence, gross profit sort of measures how much can you make by marking up your product over and above the variable cost to make it. Okay. And I should say, a lot of times gross profit is revenue minus COGS. I'm just using variable cost here, which technically would make it contribution margin, but we'll just assume it's gross profit. It's going to be pretty close. Then I take fixed costs. Okay, these are costs that are not going to vary with the amount of quantity, right? So things that are fixed relative to quantity, things like rent, things like, insurance. In other words, they're going to be set expenses and they're not going to change. You can make a lot or not much. It won't necessarily change these costs. SG&A, selling general administrative, a lot of salaries don't necessarily go up if Q goes up, right? So that'd be $25,000. All right, depreciation. So what do I have here? I've got, well, you might remember from accounting, right, that you did equals. So I'm going to do parenthesis. I'm going to say, well, I've got 90,000 is my investment, right? And then you remember I'd subtract my accounting salvage value. In other words, what I assume this will be worth from an accounting perspective at the end of the project. So that would be 0 in this case. And then I'm going to divide it by the accounting useful life, and I'll get 30,000. Okay? So my earnings before interest and taxes would be 75,000 minus 25,000 minus 30,000. So now I'll get 20,000 is my earnings before interest and taxes, okay? Then I'm going to take my marginal tax rate, so I'll take 20,000 times the 35%, okay? And I'll get 7,000. Then I'll say, okay, I want to take my earnings before interest and taxes and then subtract 7,000 in incremental taxes and get 13,000. Now, at this point, I want to make something very clear here. This looks an awful lot like an income statement, and for all intents and purposes, it is. But you'll notice I am not including interest here, okay? So it's really focusing on specifically the operating profits, okay? And I'll make more point about that as we move on. But that's going to be a big deal when we capture the incremental benefit. We're going to focus on operating benefits, operating profits, okay? And again, I'll say more as we move on. Okay, then here's what I want to do. I'm going to add back my depreciation expense, okay? And then ultimately I'll get OCF. So let me just talk a little bit more about that. Now, you might remember when I took that accounting review that we did before we got into this chapter, remember how I had net income plus depreciation. And the reason I added back depreciation is, look, if I'm looking to get cash flow, I have to understand that operating cash flow, my profits, my net income or net income type profits, subtract depreciation to get to net income. But depreciation is not a cash expense, okay? So that's why I have to add back my depreciation to get back to an operating cash flow, okay? You'll also remember when I converted from net income to cash flow from operations in my accounting statement, I was also taking into account current assets and current liability changes. I'm also going to do that coming up, but stay tuned. We'll do that in the next step. Okay, so now we have an operating cash flow of 43,000. Okay. At this point, what I want to do is I'm gonna stop, and then I'm gonna come back and talk a little bit more about the tax shield from depreciation, and then we'll talk about other items here.